Mortgage rates have almost hit under 6% again, and for some people, they are already under 6%. Now, unfortunately, all that lower rate trajectory may be coming to an end as the market is heavily predicting a federal funds rate cut in September. Now, I know I don't need to remind you that in September of last year in 2024, when they started rate cuts, mortgage rates almost immediately skyrocketed close to 1 full percentage point higher. Now, I'll show you guys that again today, but we're also going to dig into the new recessionary warnings from UBS saying the odds of recession are 93%, as well as Barclays and Moody's issuing their own recessionary warning. Now, everyone knows that absolutely nobody can afford to buy a home in 2025, but that doesn't mean we should give up on our home ownership goals in the future. And having said that, happy Friday. Welcome back to Real Estate Mindset. You guys already know this video is going to be absolutely bonkers.
We're all unable to buy a house right now, right? Like, I'm not the only one who runs the numbers every single day and looks at the budget and is just like, there is no way on earth that this is potentially feasible for me. Like, I'm working with two very average incomes. They're not great incomes, but they're fine incomes. Incomes that 10 years ago probably would have meant that we could buy a house. I digress. Anyway, we pay rent so that we can live somewhere, because when we got out of college, we had to rent so we could theoretically save money to eventually buy a home. Except rent is so astronomical that we are actually not able to save for a home.
Unfortunately, this whole push for the Federal Reserve to start rate cuts, remember, that doesn't translate into us being able to afford to buy a house. We have much bigger problems going on. So I want you guys to focus on your income and focus on protecting your purchasing power. But nevertheless, it's important to see through the propaganda. So I want to remind you that on September 18th, okay, so remember September 18th in 2024, the Federal Reserve reduced interest rates to a target range of 4.75% to 5%. This was the first rate cut since March of 2020, and the Fed expects to continue cutting rates this year and beyond. Here's our chart for the federal funds effective rate, and you guys can see they started the rate cut campaign again going down in September. So the federal funds rate went from roughly 5.33% in August of 2024 all the way down into January of 2025 to 4.33%. Now that obviously represents a full percentage point decline, again going from September to January. Full percentage point decline for the federal funds rate. But as you guys remember, that set residential mortgage rates soaring. As you guys can see here, September 19th of 2024, residential mortgage rates were 6.09%. But they adversely were affected by that rate cut campaign, because you guys can see here, they went from 6.09% all the way up to 7.04% on January 16th of 2025. So interest rates again soared almost a full percentage point during the rate cut campaign. Now, since then, they've leveled off. But anytime the Federal Reserve messes with the federal funds rate, remember, that doesn't translate into Main Street. It only helps Wall Street. If we want to know what's going on with residential mortgage rates, we have to follow the 10-year Treasury. And the 10-year Treasury has been on a roller coaster ride, even with the Federal Reserve not touching the federal funds rate. Remember that. But right now, you guys, we finally hit under 4.2 as we're sitting, at least as I'm recording this video, and we're ending September 4th at 4.162%. When we look at the last year of the 10-year Treasury, the last time it's been this low was around the end of April of 2025, as you can see on this chart here. Because the 10-year tracks residential mortgage rates, you guys can see that the interest rates have gone down. And we look at the 30-year FHA interest rate, which is right here at 6.03%, that's only gone down 2 basis points today. So as long as the 10-year continues to go down, this is going to update, and you're going to see FHA mortgage rates under 6%. Again, once this updates today, as long as the 10-year continues to drop. Now, the conventional mortgage rates are up here, sitting at 6.45%. When we look at the average 30-year FHA, not conventional, and we look over the last 5 years, so we're looking at the 5-year right here. The last time we were under 6% is right here. And we were only under 6% for a month and a half during August to September, exactly what's happening right now. But remember, you guys, after that month and a half period that you see right here, interest rates skyrocketed again, and they maintained over 6%. Now, prior to that, we got to go all the way back to April of 2023 to see interest rates under 6%. According to CME Group FedWatch, the market is anticipating a federal interest rate cut September 17th of this year. So in a couple weeks, 95.6% of the market is expecting a 25 basis point rate cut at the next meeting here in September. I want to ask you, what do you guys think is going to happen when and if they cut the federal funds rate in September? Do you think the same thing is going to happen that normally happens, where residential mortgage rates go up almost immediately after? I'm interested to hear what you think. Now, personally, that's exactly what I believe is going to happen, because remember, they don't cut interest rates unless they want to stimulate the economy. And if they're going to stimulate the economy, that means that the banks are going to generally absorb the yield or whatever the interest rate drops by. But I'm interested to hear what you think. So comment below, let me know what you think is going to happen as soon as they start the federal funds rate cut campaign again. Now we're going to go into the second segment of this video where I teach you guys how mortgage interest rates work. But before I teach you guys that power, I want to first listen to these videos, and I want to remind you guys that if you can't qualify for a good loan right now, it's okay to stop and slow down and improve your situation before purchasing a home. This is the biggest financial transaction of your life. And so you should treat it like that and not rush. But some people are going to rush, and they're going to go to loan officer until they find someone that is going to tell them what they want to hear, regardless if that loan officer can close. So listen to this video and tell yourself not to be these people.
Okay, so we just met with the bank. And when I said we were going to have faith when it did not look like it, okay, now y'all see why. Because after being told that we were not going to be able to get the house, we just found out that we could get the house. We have a lot of paperwork. We have to fill out all of this, and it's going to take...
It's going to take a hot minute.
It's going to take a while, but...
You're going to do the thing.
I told y'all we were going to have faith, and we were going to believe, even when it didn't look like it. So now you see it paid off. So let's go get this house.
First of all, you didn't get any loan until you have the keys in your hand, and you don't even have the paperwork completed or your income documents sent. And shortly after she made that video, she then made this video.
The bank just called and we can't get the loan. And as discouraged as I should be, I just feel like, I do feel like this is what God has for us, and I've just got to keep trusting him. If not, it's okay. If not, it's going to be okay. But as of right now, I feel like this is what God has for us. So I'm just going to continue to trust him. And y'all will probably think I'm crazy. Everybody thinks I'm crazy. But if this is what God has for us, then it doesn't matter what man says. Okay. Now, granted, I understand this may not be. Maybe I feel wrong. Maybe I hear, maybe I heard wrong. And that's okay. But as of right now, this is what I feel.
See what I mean? She's wasting all of that time, and she's having these people run her credit. And every time someone runs your credit, an inquiry is made. And when you get an inquiry, your credit score goes down 5 to 8 points. So by her continuing to not listen to people and continuing to push forward when she doesn't qualify to begin with, all that's doing is lowering her credit and making it harder and harder for her to qualify for a house. So you got to pump the brakes, and you got to learn how this works, starting with an amortization schedule. This is such an important form because so many people are like, if you rent, you're going to pay 100% in interest. Well, if you purchase a home right now, you're going to pay over 100% in interest, and you're going to lose money to taxes and insurance. Now, the first thing that I want to explain about an amortization schedule, which is what you guys see on your screen here, is this is how mortgage works. And what you're looking at here is not, it's so important to understand this, it's not counting property taxes, homeowners insurance, HOA fees, maintenance, and repairs. This is only talking about the debt, the mortgage. That's it. So when you add those other things that I mentioned, it becomes a lot clearer that you got to be really careful being a homeowner, and that sometimes, including right now, it's okay to rent and to improve your situation, because odds are if you can't improve your situation renting, you surely cannot improve your situation owning. But regardless, what you guys are looking at here is an amortization schedule with a loan amount of $350,000 based on 30 years. And I lowered the interest rate to 5.75%. Also, this doesn't include mortgage insurance. So it's not even including that. It's just principal and interest. And when I change this to 5.75, so we're going to act like we're getting a 5.75, what you guys need to understand is the total amount of interest you're going to pay over 30 years exceeds the loan. So your interest payments, even at a lower rate of 5.75, is higher than your actual loan amount and the actual principal. So your total interest on this loan is $385,301. So if you're going to buy a house, I want you to envision you're paying double the price that you're purchasing it for. Now, if you don't want to pay double the price, what you have to do is pay your amortization schedule down. And if you guys pay roughly $25,000 the first year and you pay for your principal to go down to $325,000, $324,000, understand, again, if you pay your loan amount down $25,000 in this scenario, you save 5 years on your loan and nearly $100,000 in interest. I actually highlighted all of the years of interest right here that you would save if you paid that loan down to $324,667. There is absolute magic in paying your principal off early. Another really important thing to understand about mortgage rates as far as a consumer is it's not the interest rates that change every single day. It's the pricing of the interest rates or the cost of the interest rates. Now, the cost and the pricing adjustments are called LLPAs or loan level pricing adjustments. And you guys get pricing adjustments for things like credit and down payment and debt to income ratio. And so what you're looking at on your screen are the LLPAs or the pricing adjustments for only credit score and loan to value. And loan to value basically means your down payment. Now I'm going to use an example of a $100,000 loan, as you guys see right here. Now the first thing that I want to say is going from a left to right, or the horizontal axis right here, represents your loan to value or your down payment. Now this star that I'm circling, okay, so the star that I'm circling, when we go to the left, okay, that represents more down payment. And the more down payment you have, the better pricing is, except where this star is here at 80% and higher. Because of mortgage insurance, your pricing actually gets better. So again, so you understand, the less down payment up to 80% loan to value, the less you have down, the better your pricing is because your loan comes with mortgage insurance. So understand that. The vertical axis right here is basically saying that the better credit you have, the better your pricing is. So you guys see that it starts at 1.75 and it goes all the way up here to only 0.125. Now, each of these boxes represents what your final cost or your loan level pricing adjustment would be. So the one that's highlighted right here represents an LLPA of 1.25%. So when we multiply the loan amount by the 1.25%, that means the fee for this credit score and down payment, which represents a credit score of 720 and a down payment of 20%, because the LTV is 80 to 85% and the credit score is 720 to 739. So you take the lowest of that. Now that represents a fee of $1,250. And that's why credit and income and down payment are important, because it affects your pricing adjustment. Having said that, now I need you to wrap your mind around locking your interest rate, because that's different. Now, when you lock your interest rate, it has the LLPAs normally built into the pricing. So you get custom pricing based on your loan application, which takes into account all of the LLPAs that we just went over. So this is a rate sheet with built-in LLPAs. Now, how this works is the interest rates are right here. The lower the interest rate, the higher the cost. Okay, now when we go to the horizontal from left to right, the longer your rate lock, the higher the cost. I'm going to use a loan amount of $100,000. And when we look at this pricing right here, so if we want to lock with the 6.125 on a 30-day lock, it's over 100, which means I get a credit. So I don't have to buy this. If I lock today, hypothetically at 6.125 for 30 days, I'm going to get a refund from the bank of $97. But say I want an interest rate of 6%. Okay, that's fine. If I take an interest rate at 6% on a 30-day lock, which is right here, it's under 100 by 44 basis points. So essentially you multiply a $100,000 loan by 44 basis points, which basically is the difference between this number right here and 100. So the first scenario that would cost you to lock at 6% for 30 days, that would cost you $444. Now, if I wanted to lock for 60 days, that's a difference of 46 basis points. So when I multiply the 46 basis points by 100,000, that means that my fee would go up only $20 to $464. So if I want to lock on 60 days versus 30 days, my fee goes up $20. And it's the pricing and the rate sheet that you want to watch every single day if you're out there shopping your mortgage. Remember, you also have to qualify, which is your credit, your income, and your assets. And you want your credit to be at least 720 and higher if possible. You want your income to be as high as possible. You want to be working W-2 jobs for a minimum of 2 years. If you have 2 jobs, you need that 2 years. If you have commission, overtime, or bonus, you need that for 2 years. Don't forget your savings and your assets. You want to purchase a house and not go broke. You want to have 6 months of savings after you purchase a home. And I know what you're thinking. How can you save money when we have a cost of living crisis?
Okay, like, do I want to work hard in my 20s and then save up? And for what? Like, what are we saving for? Like, I have a car. Everybody has to have a car, basically. Like, you can't get around. There's no buses, trains, places. We're in the US. What are we saving for? We can't afford houses. So, like, what are we saving for? What are you saving for? And so, like, do I want to work hard in my 20s and then, like, what? Work hard in my 30s and 40s and 50s and 60s and then try to retire and like enjoy my life? Like, my brain is so like already broken out of the matrix that like, why are we even working?
I'll tell you why I'm saving. I'm saving so that I can get out of the matrix financially. And unfortunately, a lot of people should be doing the same. It's essentially so you're not part of the rat race. And the other thing is, I don't want to retire and die old being kicked out of my house because I can't afford to live. It's clear that we have a society that if you don't have enough money to retire, and I'm talking $1 million or more dollars, then you have a high likelihood that you're going to either die in a hospital or you're going to die in the streets. As long as you can maintain your purchasing power and as long as you can maintain your job and your income, the likelihood that home prices continue to go down on a nationwide scale through a recession is highly likely, which is why you can't give up. It's really, really important. We try harder, the harder times are. It doesn't get easier to save, the harder times are. It gets harder to save, which means it's even more important. Recession alert. UBS puts US at 93% risk as economy slips into soggy territory. So the UBS, the global investment bank, warned that the US economy is showing a 93% risk of recession based on hard data from May to July of 2025. UBS described the current condition as stable but elevated risk, comparing it to high blood pressure in medical terms. It may not be collapsing, but it can be dangerous. Now, UBS said that the signal has reached historically worrying levels, pointing out its track record of identifying recession turning points in the past year. Fortune reported that many analysts have seen mounting signs of recession in 2025, echoing UBS's warning. UBS explained that while data looks weak, it's more like a mile-wide, inch-deep problem. The economy is soggy and soft, but not collapsing yet. After a short recovery at the end of 2025, the hard data slipped negative again, starting in February of 2025, and has stayed weak since May, showing stagnation instead of sharp decline. UBS stressed that none of the big economic indicators like jobs or production are collapsing below trend, which usually happens right before past recessions. The message: the US economy is stuck in slow growth or mild contraction, not a sudden crash. Analysts warn this could mean stagflation, which means low growth with rising inflation similar to the 1970s, according to the report by Fortune. Despite the 93% risk signal, UBS is not officially predicting a recession. Instead, it expects soggy growth in 2025 with improvement in 2026. UBS averaged all signals such as hard data, yield curve, and credit stress to get a 52% overall recession probability in July. That is up from 37% in January. This level is often linked with recessions in history. Zandi is saying that the biggest danger of recession is going to come winter of 2025, putting the odds of a recession at 50-50. He added that states that make up 1/3 of the US GDP are already in recession or close to it, while only 1/3 of the economy was still growing by late August. Now, JP Morgan also raised alarms, saying that the sharp drop in labor demand is usually a recession warning signal. As such, downshifts in job growth often lead to retrenchment. Overall, UBS and other economists say the US economy is weaker than a soft landing, but not fully collapsing yet, and leaving 2025 on a knife's edge per the Fortune report. In a research note published August 25th, Barclays reviewed that the U.S. economy has likely entered a stall state. The bank's tipping points model now placed the odds of recession within the next 2 years at 50%. It's so important to remember that young adults have never gone through a real recession in their lifetime. So when you ask the question, what does a recession even look like to Generation Z? I'm going to tell you guys right now, primarily, it's painful, and it's probably going to look like charge-off, credit card debt, and bankruptcy. And through that pain and through that uncertainty, you're probably going to learn a lot how important credit is and how important debt is. But if I really were to sum it up, I would say that it's exactly like what she's saying.
Boomers want to know what it's like being young in 2025? Here it is. I just got off an 8-hour shift at work where I make double minimum wage in my state. I hop in my car, check my banking app. Cool, I've got $50 to last me till next week. Then I remember, oh, I have to run to Walmart because the wire in my bra snapped. I don't have underwear because it keeps going missing. My eyelash curler broke, and I have no food. I bought 4 things. 4 things, and it came out to $40. I'm living off granola bars. But I hop my depressed back in my car, and I look at my banking app again. Oh, cool, I've got $10 now to last me till next week. I try to drive, but my car keeps misfiring. I can't afford to fix that. So I keep on parking, turning off my car, turning it back on until it decides to act right. 30 minutes later, I'm finally heading home to my 4 roommates. I pay $8.50 a month. Now give him that's everything included. But $8.50 a month with 4 roommates. Remember back in the good old days when a man could afford to feed, raise, house his family on minimum wage? And he had a second family on the side who he also housed, fed, and raised. You know what I say to all that? You guys had it so easy, and then you destroyed everything behind you.
Comment below, what do you see happening for Generation Z during a recession? Do you guys think that most of them are going to be strong, going to be okay? Or do you think they're going to get wrapped up once again in bankruptcy, foreclosure, and eviction? Let me know what you think. Now, having said that, guys, if you're out there just investing in real estate, trying to figure things out, you guys already know I wish you luck, and I hope you win.